So I was looking at this stack of articles we pulled for today, and it's wild. I swear, depending on which one you pick up, you're reading about two completely different universes.
Completely different. Yeah.
In one, you've got this miraculous engine of prosperity. I think that was a quote. It funds vaccines, builds infrastructure. It's the only reason, your grandma isn't eating cat food in retirement.
It's the golden goose.
Right, but then you pick up the next source, and whoa, suddenly we are staring into the abyss. It's a high-stakes casino.
Or satanic. That one jumped out at me.
Yeah, satanic.
Yeah.
A system designed by the rich, for the rich, that just sucks wealth out of the real economy. The one where we all have to buy groceries.
And that disconnect is massive. And usually when we see that kind of polarization in the source material, it means we're touching on a real nerve. The question isn't just about money.
Yeah.
It's a moral question. I mean, is the stock market evil?
It feels like such a loaded question, but then you look at the news GameStop. Flash crashes, massive layoffs, just to boost a stock price. And it feels fair.
It's a fair question.
I mean, we've got listeners right now looking at their 401ks wondering, am I part of a scam or am I part of a miracle?
Or maybe a bit of both. And I think that's where we need to land today. I mean, we're not here to give investment advice, obviously.
Why not?
We're here to dig into the economic theory, the ethical debates, the psychology, and just try to figure out, is this thing a monster we created or is it something else?
A monster or maybe just a tool? Okay, let's start with the monster. Let's make the case for the prosecution. Because if you just look at the vibe of the market lately, casino feels like the polite term.
It really does. And that casino criticism is the first big pillar of the argument. The idea that the market has completely detached from the reality of, actual goods and services.
There's the whole meme stock phenomenon.
It is, but it's even deeper than just GameStop or AMC. It's the idea that price no longer equals value. I mean, in a rational world, a stock price should reflect how much money a company is making, right?
In theory, yeah. The present value of future cash flows, all that.
Exactly. But what we're seeing now and what the critics are really screaming about is just pure speculation. Hype is driving prices. Reddit threads are driving prices.
Just momentum.
Yeah, just momentum. When a car company that hasn't sold a single car is suddenly worth more than Ford, well, that doesn't look like investing. That just looks like gambling.
It looks like a bubble. But,
Oh,
I mean,
wow.
bubbles burst. People lose money. It happens. The evil label, I feel like it comes from something more systemic. Like the game isn't just random. It's actually rigged.
And that leads us right to high-frequency trading, HFT. This was a huge chunk of the reading.
Oh, man, the Flash Boy stuff. The fiber optic cables they laid through mountains just to shave a single microsecond off a trade. It's nuts.
It sounds like science fiction, but it's the plumbing of the market now. We're not talking about guys in jackets yelling anymore. It's all algorithms. And the big criticism is about something called front running.
Okay, so explain that. Because I think people hear algorithm and their eyes just glaze over. How does a robot actually cheat me?
So imagine you're on your phone, you go to your brokerage app, and you click buy on a share of Apple.
Okay.
That order has to travel electronically to an exchange. Well, the high-frequency traders have computers that are physically closer to the exchange. They're faster, so they can literally see your order coming down the pipe.
Oh, no.
They race ahead of it, buy that stock milliseconds before you do, and then sell it to you for a fraction of a penny more.
So they're just scalping every single trade.
Pennies. Fractions of pennies. But you do that billions of times a day.
And it becomes billions of dollars.
It's billions of dollars transferred from regular investors to these huge firms. It just creates this feeling that the market is predatory, that you're at a poker table where the dealer can see your cards before you even look at them.
It just destroys trust.
Mm-hmm.
If the game feels rigged, why would you even play? But, okay, even if we set the robots aside, there's a human element in the prosecution's case that I found even more damning. This idea of short-termism.
Quarterly capitalism.
Yes. The idea that because companies have to report their earnings every 3 months, they literally can't think past the next 90 days.
And this is arguably the most destructive piece of the whole puzzle, according to the critics. If you're a CEO, your one job, your fiduciary duty, is to maximize shareholder value. And the market is so impatient.
So impatient.
Miss your earnings target by 1 penny and the stock gets hammered. You could lose your bonus, maybe even your job.
So you start to cannibalize the company just to feed this quarterly beast.
You do. You cut research and development, you suppress wages, you fire 5,000 people, even if the company is profitable, just to make the margins look a little bit better for the next earnings call.
Or you do the environmental damage.
Exactly. Or you ignore the long-term damage you're doing to the planet because fixing it would cost money today, and that would hurt this quarter's numbers.
Okay, but let me play devil's advocate here for a second. Doesn't that pressure also keep companies efficient? Like, if we didn't check their homework every 3 months, wouldn't CEOs just waste cash on private jets?
That's the classic counter-argument, and sure, discipline is good. But the sources we read argue that the pendulum has just swung way too far. We've prioritized this idea of efficiency over resilience, over, humanity. When you treat your workers, actual human beings, as just a cost to be minimized to make a chart go up, you get a society that just feels completely used up.
Which is the perfect segue to the whole inequality piece. Because all this efficiency, all this growth in the stock market, who's it actually for?
That's the decoupling. That's the term they use.
The idea that the stock market is not the economy.
Exactly. We see the S&P 500 hitting all-time highs, the headlines are cheering, the economy is booming. But at the same time, real wages for most people have been flat for decades.
Just stuck.
And the sources pointed to this one brutal statistic. The wealthiest 10% of households in the U.S. own nearly 90% of all stocks.
90%. Wow. So when the market goes up, it's really just a wealth transfer to people who are already wealthy.
And it creates this vicious feedback loop. Wealth generates dividends and capital gains. That creates more wealth. Meanwhile, if you just work for a paycheck, you can't keep up. It just widens the gap. It makes the market feel like this exclusive, gated community.
Okay, so let's pause there. The prosecution rests. The market is a rigged casino. It forces companies to be cruel and short-sighted, and it's driving inequality to a breaking point. I mean, honestly, it sounds pretty defenseless. Why would anyone keep this thing around?
And yet, it is the fundamental operating system for the entire global economy.
So there has to be a defense. What is the miraculous engine argument?
The defense really hinges on one massive idea: utility. You have to look past the noise and see what the market actually achieves. The term is capital formation, which sounds boring, but it's a miraculous process.
It's about making big things happen.
Exactly. Just think about the modern world. The device you're listening on, the clean energy tech being built, the companies developing cancer treatments. These things need billions of dollars of risky cash up front.
Yeah, you can't just go to a bank and say, hey, give me $1 billion for an experiment that might totally fail.
No bank on earth would do that. Banks are conservative. The stock market is where society puts its risk capital. It allows a company to say, hey, I have a crazy idea for a new kind of battery. Who wants in?
And millions of people can say, sure, I'll throw in $100.
And suddenly you have the capital you need to literally change the world.
So without the market, we're basically stuck. We only get slow, safe innovation. We don't get the moonshots.
We don't get the moonshots, and we don't get the same kind of efficiency. One of the sources called the market a brutal sorting machine. And they actually meant that as a compliment.
How so?
Because it kills bad ideas. If a company is poorly managed or their product just isn't working, what happens? People sell the stock. The price drops. The company can't raise any more money. And it dies.
So capital naturally flows away from failure and towards success.
It's Darwinian, for sure. But it ensures that our collective resources aren't just wasted on things that don't work.
Okay, so it's good for society with a capital S. It builds the future. But what about the person who isn't in that top 10%? You said yourself the ownership is so skewed. How does this system help the little guy?
This is the democratization argument. And
What?
it's flawed, but it is also real. Before the modern stock market, if you wanted to own a piece of a growing business, you had to be a tycoon, you had to be a Carnegie or a Rockefeller.
You had to buy the whole factory.
Right. Today, a nurse, a teacher, anyone with a brokerage account, you can own a piece of Apple. You can ride the coattails of these incredible companies for the price of a nice dinner.
But you have to have the spare cash to do it.
That is the big catch, no question. But for the millions who can participate, especially through their 401ks or pensions, it is literally the only reason they can retire.
Because of inflation.
100%. If you just stuff your savings under a mattress, inflation just eats it alive. It loses value every single year. The market is one of the only places that has historically beaten inflation over the long run.
It's the engine that turns labor money into capital money.
For the middle class, yes. Without it, the whole concept of stopping work at 65 is it's a mathematical impossibility for most people.
There's one more point the defense made that I think is easy to overlook. Liquidity.
It sounds so boring.
It sounds incredibly boring, but it's actually huge. Explain why it matters.
Okay, so imagine you invest your life savings into opening a restaurant. A year later, you need your money back. What do?
You have to find a buyer, negotiate a price.
Right.
It's a whole process.
Right. It could take months. You're locked in.
Oh.
In the stock market, you can click a button on your phone and have cash in your bank account in days, sometimes seconds. That liquidity makes people more willing to take the risk of investing in the first place because they know they can get out if they need to. It's the escape hatch. And for entrepreneurs, it's everything. It's the reason they start the company to begin with.
Okay. So now we have two completely convincing, totally contradictory stories. One is a predatory inequality machine. The other is the engine of all human progress and the only way to retire. So, what's the verdict? Is it a monster or is it a mirror?
And this is where we get into the more philosophical part of the sources, which I found really fascinating. The consensus isn't that the market is moral or immoral. It's that the market is amoral.
It just doesn't have a conscience.
It has no conscience whatsoever. There are two analogies that really stuck with me. One source compared the market to a fire. Fire is incredibly destructive. It can burn down your house, but it also cooks your food and warms your home. It makes civilization possible. You don't call fire evil. You just respect it. You build a fireplace to contain it.
And if your house burns down because you didn't build a fireplace, you don't blame the fire.
Exactly. The other analogy was a knife. A surgeon uses a knife to save a life. A killer uses the same knife to take a life. The knife itself is just a tool. The morality is in the hand that holds it.
Which brings us back to this mirror idea. The market isn't imposing its values on us. It's just reflecting our own values back at us on a massive scale.
It's a psychological amplifier. The market is just millions of humans making decisions. It doesn't create greed. It just aggregates and scales up all the greed that's already there.
Right.
It doesn't create panic. It amplifies the fear we all already feel.
So when we see a bubble, we're just seeing collective mania. A crash is collective terror.
Precisely. And that's why the evil outcomes, the pollution, the layoffs, why they happen. The market is programmed to do just one thing: maximize profit within the given set of rules. So if the rules of society say, hey, it's legal to dump toxic waste in the river, the market will reward the company that does that because their costs are lower.
The market says, good job, you made more money. It doesn't say, bad job, you killed all the fish.
It doesn't even know about the fish. That's the key. The market is just a very powerful calculator. It's not a priest. So if we want the market to produce good outcomes, we can't expect it to regulate itself. We have to change the rules. Regulation is the fireplace that contains the fire. If you have strong labor laws, good environmental protections, strong oversight, the market will still be ruthlessly efficient. But it will be efficient within those moral bounds. The evil comes from a lack of oversight.
That really puts the responsibility back on us, which is uncomfortable.
Yeah.
It's so much easier to just blame the system. But this brings us to the final piece. Agency. What do we as listeners actually do with this? I can't go rewrite SEC regulations tomorrow.
Yeah, but you can control how you choose to interact with the tool. And there's this huge shift happening right now called ESG investing.
Environmental, social, and governance.
Yeah, it's become a bit of a buzzword, and it has its own issues, but the core idea is pretty revolutionary. It's investors saying, okay, I am now going to use the power of capital to enforce my ethics.
Voting with your dollars.
Exactly. I will not buy your stock if you use child labor. I won't invest if you pollute. If enough capital does that, what happens? The stock price falls, and suddenly the CEO cares. Not because of a moral epiphany,
but because the calculator is giving him a bad number.
The market is now punishing him for being evil. You're using the machine's own logic against it.
I like that. That feels powerful.
And on a personal level, the sources all draw a really sharp line between speculating and investing. If you treat the market like a casino, if you're chasing meme stocks, trying to time the market, you are feeding the monster. You're part of that instability.
Playing with the matches.
You are. But if you invest with a prudent mindset, buying broad index funds, holding for the long term, looking for real sustainable value, you're using the tool as it was intended. You're providing capital to the real economy and securing your own future.
So we can choose to be gamblers or we can choose to be owners.
Exactly. The market is just a mechanism, the intent, the morality that comes from us.
It's funny, we started this whole deep dive wondering if the stock market was this separate alien thing that controls our lives. But it really sounds like, in the end, It's just us.
Yeah.
It's all of us, aggregated, screaming and bidding and panicking and
It's
building.
a mirror, a very loud, very expensive mirror.
So here's the thought I want to leave you with. The next time you see that ticker tape scrolling across the news, or you see a headline about a market crash or a record high, try not to look at it as a judgment from some financial god on high.
Look at it as a reflection.
And maybe ask yourself, if that mirror is showing us short-term greed and panic and widening inequality, maybe the market isn't the thing that needs to be fixed first. Maybe we are.
That's the messy middle.
Thanks for diving in with us. We'll see you next time.